Hi, it's Richard Hemming from Under the Radar Report. Now that we're nearly at the end of the fiscal year, it's the time when we get really excited here at Under the Radar. Why is that? Because we're releasing our new dividend portfolio. Look, we do these every 6 months. Why is that exciting? Because dividends, people, are the new black. Look, I'll go through two candidates for the upcoming portfolio in a second, but let me tell you why it works. We've had 18 of these portfolios. Our average return, 15.8% a year. That's over something like 10 years. Compared with the All Ords Index return, what's that? 4.9%. So dividends are where it's at. Getting money from companies is as tax effective as ever. And I would argue that this is what separates Australia from the rest of the world in investment terms. We lead the pack. But basically, that is the first factor. There are 4 other factors at play here in terms of why these portfolios consistently outperform. The first one is the power of diversification. Some stocks, but not all, certainly the vast majority, are not major index players or are not even peripheral index players. So what you're getting is genuine diversification. So you're separating your performance out from the index. You are really being able to generate bigger returns from stocks that other people don't own. So this brings me to the second point, which is what we call the 20-80 rule. We go through this rule in our report this week, but 20% of the stocks deliver 80% of the return. Like that is, time and again, this is the case, especially exacerbated over time. And over time, we get outperformance because consistently the stocks we choose get taken over, but also we rebalance these portfolios every few years. So they're low touch, but we rebalance. There are takeovers, so we're able to maintain strong performance. But the last point I think is crucial, and that interest rates are going to be higher or at higher levels for longer. This has really benefited recent returns for us. Like basically, we're getting accelerating returns. In the past few years, our small cap dividends have performed 20% a year versus the All Ords performance of like 5% a year. So what we're seeing, across the world, around the world, is that inflation is sticky. Inflation is much stickier than they'd anticipated, for many reasons. And this is not going to change. Look, you need income producing assets. You need income producing assets for protection. That's what you need across the board, like whether it's small caps, big blue chips, whatever the asset is, you need income producing assets to protect yourself from inflation. But in the stock market, you also get the leverage effect. So you get the effect of basically increasing revenues, boosting that income. So that's actually income that's going faster than inflation. What you're getting in small caps is a supercharging of that effect because you're getting even better operating leverage. So let's get on to the stocks. Okay, first one is Acro, also sort of previously known as Acro Formwork. ACF is the code. I've liked this stock for a long time because it's got fantastic management. Basically, they're a scaffolding and formwork specialist, so they're leveraged to construction activity. We've liked it in the past, but we've gone back into it, in recent times because it's underperformed. Why is it underperformed? Because we've seen costs in construction ramp up, so that's been a headwind for them. What we've also seen with Acro is increasing capital expenditure or increasing investment. Why have they done this? They've done this to position for the Olympics. That's right. For Brisbane 32, they are really well positioned to get increasing work. And certainly we've been encouraged by a recent trading update that showed a boost in the contracts. So this stock does have some debt that's funded that investment. So that's one of the reasons why it's been under pressure. But we don't think the debt is out of control. It's around 2 times operating earnings, which is at a comfortable level, but one you want to see going down. So they're not going to be spending money on CapEx, not like they have in the past, and they're going to see windfalls from that previous investment. So dividend yield of 5.6%, our forecast 5-cent dividend, we think safe, worth having a look at. Second stock, XRF Scientific, one you might not have heard of if you're not a subscriber, because this is another one we're really familiar with. We've backed for a long time, but another one where we've taken the foot off, as the stock really outperformed, and then got interested in as the stock came back. Basically, this is a mineral testing specialist. So what we like is that it's at good value. The stock got heavily sold off at the last result, not because they weren't growing profits, but because they weren't growing profits fast enough for the market's liking. So there is profit momentum, and we saw that in the final quarter of FY25. We're seeing that we're seeing new contracts at XRF Scientific, and we're seeing once again a dividend that's underpinned by a strong balance sheet. They've got net cash, but also earnings momentum, so they're cash flow positive. So this is a good stock for mine in terms of dividend growth. The dividend yield is less than 3%. Since we've tipped it, the stock's actually gone up a bit. So that we tipped it when the dividend yield was 3%. It's around 2.7% now. But I guess the key point is that you're buying this stock for growth. So the low dividend yield should not put you off. It's all about growth in small caps. And that's why some of the lower yielding stocks that we've bought initially have actually been some of our best performers in the portfolio. With small caps, it's all about growth.